The more developed your financial system, the more developed your banking system, the more crisis prone it is. So what more developed countries have done is they empower banks to do that. And that's why their systems are a little bit more prone to banking crisis.
Today we have George Lagarias, the chief economist at Forbes Mazars, with 20 years of experience in financial markets, 9 in Athens and 11 in London. George has built an amazing career offering a wealth of knowledge in economics and investment strategy.
The boom and bust cycle are part and parcel with capitalism. The other choice is to have a centrally planned economy, but that means just leaving the greed and the gloom to the government bureaucrats instead of people. There is no perfect system. What I learned was a demand shock is not the repercussion of an election, and demand shock happens when there is uncertainty.
If you had to predict one major transformation in global finance over the next decade, what would it be?
There are two things that I see. The one is
This is The Blonde Dollar with Ignacio Ramirez. Quick disclaimer, the views and opinions expressed in this podcast are those of the speakers and do not constitute financial investment or legal advice. This content is for informational and educational purposes only and should not be relied upon as a substitute for professional advice. Always do your own research and consult a qualified advisor before making any financial decisions. All investments involve risk, including the potential loss of capital. And now, let's get started with the episode. Welcome everyone to a new episode of The Blonde Dollar. Today we have the privilege of speaking with George Lagarias, the chief economist at Forbes Mazars, with 20 years of experience in financial markets, 9 in Athens and 11 in London. George has built an amazing career offering a wealth of knowledge in economics and investment strategy. His career's trajectory is both diverse and impressive. He held roles in various financial institutions, including positions as an investment analyst, as a fund manager, and as an investment writer. Since joining Mazars Wealth Management in 2016, he's been instrumental in shaping the firm's macroeconomic perspectives and investment strategies. His previous roles include positions at Close Brothers Asset Management, EFG Asset Management, and Marfin Asset Management, where he managed multi-asset class funds and equity portfolios. George holds an MBA and a Bachelor of Science in Accounting and Finance and is IMC and CF30 certified. So quite a legend and very, very strong technical background there. George, welcome to The Blonde Dollar.
Nice to meet you, Nacho.
So very, very excited to have you here with us today. Obviously, a lot of the conversation is going to evolve around your job as a chief economist, but not only. But I'd like to start with that. And to me, when I think about a chief economist's job, for some reason, the first thing that comes to mind is how an economist navigates financial crisis. And given that you're Greek, I wanted to start directly asking like tough questions. I want to talk about the Greek debt crisis, which you obviously experienced firsthand. So you were in the front lines of the industry during all that period. Obviously, a lot of people saw the headlines, but you, as a Greek, obviously lived it probably closer than most of us. For context, the Greek crisis happened in the aftermath of the global financial crisis of 2008, on the year after mostly. And since then, I mean, there's different stats, but what I've read is that, the Greek economy suffered the longest recession of any advanced mixed economy to date and became the first developed country whose stock market and ratings also were downgraded to that of an EM back in 2013. And as a result, many things happened. The Greek political system was upended, social exclusion increased, and hundreds of thousands of well-educated Greeks left the country. So my question for you is, what was it really to experience the debt crisis in Greece from the inside?
So not only did I work in Greece, but also I worked for a bank that failed. That was Marfin. It was later absorbed by another bank. And because it was a Cypriot bank, the pain was compounded because I also lived through the Cypriot blow up as well. And the answer is, when you ask how it feels, the answer is it's not something that you think will ever happen to you. Even as it happens, you maintain the optimism and you say, okay, surely it will not be as bad as that. You see, it's very easy to be pessimistic about others, extremely difficult to be pessimistic about oneself. Okay, humans are built like that. We think of death as something happening to others. Okay, when you contemplate your own mortality, you have a midlife crisis. So it's not something that terrifies you because your mind keeps pushing it away as something that happens to others generally, and you maintain an optimistic stance. Okay, and ultimately at the end of the day, it is a financial crisis. Yes, it's not a war, it's not death and destruction. You can always rebuild.
So how would you say that the crisis affected the mindset of the country? Because obviously behind every crisis, there's millions of people dealing with this uncertainty. Do you feel it left some scars, or people are or have always been pretty much forward-looking and it's something they don't really think about anymore?
No, the crisis has definitely scarred the country. It scarred our economic and political system. To this day, Greek debt is owned by foreign governments, not markets, who require a 2% primary surplus every year, which means that fiscal policies are and will remain tight. If you know anything about the economy, maintaining consecutive fiscal surpluses is something extremely painful. Okay, the job market remains frozen. So although unemployment has fallen to very high single digits, the job market is frozen. Okay, and that creates a feeling of, especially to the younger generations, a feeling of despair that they're not going anywhere. So most of them, once they get their degree, they also grab their passport and leave, which is a very smart thing to do, because if you leave at the age of 33 like I do, you still have to start from scratch. Okay, that's what happens when you leave your country. Okay, you can build up again quickly if you have the knowledge base, but you still have to start from scratch. Or thereabouts anyway. Young people have mostly given up. That's the answer.
That's quite unfortunate. It's the famous brain drain that we hear so often.
No. The brain drain is one thing. So the brain drain is, okay, you can argue that some of the more educated have left, but you can't argue that those who have remained are, the weakest links. It doesn't have to do with the brain drain, because there are young people here, but they're frozen in time. They're not going anywhere. Okay, well, in the last few years, I had certain offers since I moved back to Athens. I had certain offers that I ended up rejecting all of them. And the reason behind this is that the frozen leaderships, no one is going anywhere. So there's no mobility. And that is pretty much what a post-crisis country looks like, especially if that crisis never reached the end resolution, which they never do. Look, don't forget Greece. Special situation, how it was saved. Look at Argentina. Pretty much a similar mindset. Young people leave, and those who stay back, they fight against very difficult odds. Okay, so once the default cycle starts, the toll is generations.
So, maybe taking a step back from Greece and talking about crisis in general, because whether it's the dot-com bubble, the global financial crisis of 2008, the recent crypto collapse, you name it, like financial history seems to be on repeat with these things. So why do markets keep making the same mistakes in every crisis? Is it just human nature? Why do we keep getting to these very tough situations?
First of all, we have to we have to discern between financial crisis and debt crisis. Big countries, G7 countries, generally speaking, they are past their debt crisis cycle. A lot of them have had debt crisis in the past, but that was up until the beginning of the 20th century. Okay, so debt crisis can have a very long and lingering and generational effect on a country and its economy. Okay, financial crisis, on the other hand, literature shows that no country is exempt from them, especially the more developed ones. So the more developed your financial system, the more developed your banking system, the more crisis prone it is. I know that sounds a little bit counterintuitive, but that's what literature teaches us. So what more developed countries have done is, yes, they have more stable government financing, but because growth needs to come from somewhere, they empower banks to do that. Okay, and that's why their systems are a little bit more prone to banking crisis. And because it's the big countries, they tend to export that to the smaller countries who are also faced with with their own fiscal crisis, and that compounds their problem. Now, why do we keep making the same mistakes? It is going back to the same feeling and the same sentiment. This will not happen to me. It's optimism. This time is different.
The four most dangerous words in finance, as they say.
And we forget. Case in point, in the past few months, it's all been about deregulation. Fine, we'll kickstart growth with deregulation because we need to, because we cannot saddle government debt anymore. So we need credit to substitute government debt. But down the line, we're going to pay for it with a new financial crisis, which is being written as we speak. It might be in 2 years, in 3 years, in 5 years, in 1 year, in 10 years, you never really know. But its first pages are being written as we speak.
And what role does fear and greed play in all of this? Because if I hear you, like, it seems that financial markets and this crisis are fundamentally built on cycles. But yeah, which role does behavioral finance play in all of this? And is there a way to prevent these extremes, or you think we're pretty much doomed?
I think I wouldn't use doomed. It is part and parcel of capitalism. Capitalism is prone to cycles, as you say, and we've known this ever since the 17th century. When the Dutch West India Company issued the first shares. Okay, capitalism has been prone to crisis ever since the tulip mania in Holland 4 centuries ago. Okay, we know this. There are ups and downs. So it's not that we're doomed. We have to embrace this. Okay, cycles end, and cycles, we have an excess because of greed. What you call greed, for some, it's an opportunity. If somebody puts money in front of you and says, okay, now it's just easy to take it, will only carry a small risk, then you take it. And if you can pass the bill to somebody else, then you likely will. Okay, the boom and bust cycle are part and parcel with capitalism. The other choice is to have a centrally planned economy, but that means just leaving the greed and the gloom to government bureaucrats instead of people. So there is no perfect system. We've known this since antiquity.
Mm-hmm. So you don't see this crisis as a failure of regulation. You don't think, governments and central banks are responsible for it. It's just like a natural part of financial markets, really.
Even what you call failure of regulation is a cycle in and by itself. We regulate, then we over-regulate, we strangle the economy, we make the government take on more debt. The government cannot take on more debt. We need to use the banks. We deregulate banks so that banks can create credit. Excesses happen, new cycle, no, we'll never do it again. And half a generation or a generation later, it's the same thing.
So really, it's not like there's anyone being responsible for this crisis. It's not the result of bad policy or irresponsible investors or things like that. It's just like part of a healthy financial market at the end of the day.
A bad policy, an irresponsible policy, is part of the deregulatory effort. Or a bad policy can be the result of overregulation. You can never get it quite right. You can never get anything quite right. Okay, sometimes you need more state, sometimes you need less state. So Plato tried to find the perfect system. Thomas More in his Utopia tried to find the perfect system. There is no perfect system. There is a system that is a good system for that time. But as times change, and because human nature is in itself malleable and changeable, that means that the perfect system will always remain elusive. So think of it as a pendulum. More state, less state. Sometimes we need more state, sometimes we need less. Sometimes we need more, sometimes we need less. Okay, and then you have an electorate that just trying to stop the pendulum at just the right point. Okay, you will find wisdom in the masses there, to be fair, but still, developments will always be one step ahead of you, because just when you think you got it nailed down, the world is moving on. So no, there is no perfect system. And there cannot be in nature. Ever heard of Kurt Gödel?
Well, just superficially, but not as much in depth as what you're about to tell me, I guess.
So his incompleteness theorem, along with Heisenberg's uncertainty principle and Einstein's theory of relativity, which shaped the early 20th century, his incompleteness theorem added about 25 centuries of philosophical search for a perfect algorithm that would simply explain everything. Because the perfect system is, one way or another, it's a perfect algorithm. Okay, but now we know, even mathematically, that's impossible. Even in mathematics, mathematical axioms tend to sometimes clash with each other. And that's what Kurt Gödel showed. And he ended a 25th-century dream of finding an optimal algorithm that will help explain and will keep things always balanced. Balance is something that is very, very short-term in nature. Okay, entropy, I'm still going back to physics. Entropy teaches us that there is only a very small probability that the system will stay perfectly balanced, and in every other occasion it's going to be imbalanced. And that is human nature, and in a democracy I would argue that this is even compounded. Because democracies are much more energetic and vibrant than other systems, which means that they are more changeable. So you go from here to here, from here to here, from here to here. What is the perfect system for all of these?
So going back to markets, then, if I hear you, like you're saying, I mean, it's not about whether who's responsible or not, but it's just a part of how the world operates. So could there be a case to be made that financial crises, while painful, are actually a natural part of capitalism, and that they even could help economies over the long run in some way?
I'm not sure they can help economies. I'm saying that they are as inevitable as the bill at the end of a lunch. Okay, there are no free lunches. And the more, again, philosophical question is, Nacho, would you go to a party knowing that you will get a hangover, but still go because you want to have a good time? Or would you avoid the party altogether so that you never get a hangover?
Depends on who's going. That's my answer.
Depends on whether you have children. But
exactly. When do I have to wake up tomorrow morning?
This is how markets operate. And you know what? Most of the times people like to go to the party.
That's a good analogy.
When the party is there, you're going to join it. Say Nvidia trading 100 times its, which it was about a year ago, 100 times its forward earnings or what have you. You want to go to the party, you want to make the profits, you want to buy that house, and we'll see what the future brings.
Interesting. So okay, so we've been digging a lot on this crisis topic, which is a little bit almost very harsh. I wouldn't say depressing because it's part of the world and our history, but maybe maybe I should have started with a more cheerful part. So let's maybe take a step back now because I have the feeling that we jump straight into economics. But let's talk a bit about you actually and what you do. So you are the chief economist in a major financial institution. I guess a lot of people don't really know what a chief economist actually does. It sounds like a very big title, but it's probably unclear to many what it actually means day to day. So in your own words, what does your role as a chief economist at a major financial institution really entail? Hey there, quick favor to ask. If you enjoy the blunt dollar, the unfiltered takes, the stories, and the laughs, the easiest way to support the show is by tapping that subscribe button right now while you're listening. And here's my promise. If you do, I'll keep bringing you honest conversations, fresh perspectives, and the kind of finance talk that's engaging, insightful, and worth your time. Thanks so much for being here, and let's keep these great finance conversations going.
Still trying to figure that one out myself. In terms of you, no more and no less. People want your view on certain issues. How will the economy play out? Where consumers are at? Anything that is present and current or historical, it's very easy to answer. You just dig into the numbers, create a chart, blah, 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 and you know exactly where things are. Almost about a month at least ago, because that's the most recent data that we have. And some models can tell you maybe where you're at now. They're called nowcasts. But the chief economist, chief investment officer, I would argue chief executive officer, chief technology officer, even CFO, is never about the present. Anyone can do that. Anyone can tell you the current state of affairs. The chief is a person who, to quote Jeremy Irons in Margin Call, listens to the music and tries to figure out whether the music is playing, whether it's playing louder, whether it's playing softer, and when it has entirely stopped. This is the only thing a chief of any kind is supposed to do.
Great movie, great book, by the way, for those of you that haven't read or seen it. So what is the most difficult part of being a chief economist then? Like trying to listen to this music and really figuring it out when the tune or the rhythm changes, or is it something else completely?
Well, you listen to the music. The hardest part, I think, is to get people to overcome their own biases and listen to you when you have something to say that they don't like. If you say the economy is not in a good place, people don't like to hear that. If you say that market risks are now excessive, people don't like to hear that either. People like to hear the good news. They never want to hear the bad news. Okay, and that is the hardest part. That about half the time the news is bad.
So actually, that was a follow-up question that I had. How do you approach situations where the news you have to deliver, your economic outlook, for example, isn't what people want to hear? How do you deliver those bad news?
20 years of experience. That's how I deliver it. I've done it for many years. People know who I am. They know that I don't always prophesize doom and gloom. The deregulatory efforts, we've been talking about them for 2 years. You've seen my attitude on parties. It's better to go than not to. Okay, but the hangover will come and so will the bill. Okay, so I approach it with knowledge of history, with some gravitas that 20 years of experience bring. If people want to listen to it, that's fine. If people don't want to listen to it, that is fine too. because I don't always get it right.
Mhm. I heard a good way of delivering bad news is called the sandwich theory. A good friend of mine told me this, which is you start with a bit of not so bad news, or maybe even neutral or good news. You end with some neutral or good news, and you put the big bad negative stuff in the center, and that way it's a little bit easier to digest for the people hearing them. What do you think about that?
I think it's cultural. I'm not sure where sandwiches fit into all that, but I find big differences in culture. Greeks, French people, they want the bad news straight off the bat. They want to hear it. Okay, English people, I work in a British company, they want it delivered in a very careful language. Okay, one that will not necessarily upset people. So, Italians may not listen to them at all. Greeks may, they may attack you for the bad news. Okay, kill the messenger. It's very, very cultural. How do you deliver bad news? Okay, but
Yeah.
also in my, so I'm not a newspaper person. I don't deliver news. I deliver opinions, and that is the cool part, because an opinion is never really bad news in and by itself. It might be an opinion that people find uh that they don't necessarily agree with, or they find it too pessimistic, and that's fine. Okay, it's up to them. It's up to the decision makers to take that opinion and leave it, or come back for another if they feel that worked out. You see, so I don't have anything to worry about.
Well, I kind of disagree about the fact that opinions are, I mean, they're not necessarily bad news because it's just an opinion. Because, I mean, obviously there's the valuability, the credibility of the person delivering the message. So if I have George giving me an opinion, which is a bad view on an economy or something happening, given how much you know about the market, yeah, I do acknowledge, I know that there's a chance that you're not getting this right, and what you're saying is never going to happen. But there's a very big chance that that may actually materialize, and hence, even if it's just an opinion, I'll be, oh damn, I'm not happy to hear this. Um,
Well, so make no mistake, it has cost me a few relationships, the more pessimistic opinions, and it probably has cost me a couple of promotions too. Um, but I don't think about these things for a second. People ask me for an opinion, and I'm going to give it to them, and I will do my homework, and I'm going to give it to them as honestly as I can. After that, there's zero regrets.
mm,
Okay, and I could change my opinion if the data changes. I'm going to swiftly change my opinion about everything. Okay, but because I know how much work I put into every opinion before I open my mouth, see, that's the important stuff. If I have done my homework, if I have done my thinking, not my homework, not my reading, but my thinking, then I am serene in delivering good news or bad news. And again, it's up to the person how they receive it, but that's their struggle. It's not mine.
mhm. So how much is it about data and how much is it about the actual message? Because obviously a great economic analysis needs to be accurate, but if decision makers and clients don't understand what you're trying to say, it's useless. So in your experience, what's more important for a chief economist? To be precise with the data, or to be persuasive in how you communicate the message?
Ever heard of the University of Michigan Sentiment Index? Very popular in the markets, right?
Of course.
So this is a sentiment index for U.S. consumers, out once a month, twice actually, because there is the interim index as well. So they used to have this great economist called Richard Curtin, and he would look at the data, the consumer data, and he would give you a story around it. Now, eventually, after 30 odd years, I think Curtin changed and he was replaced. And his successor, I think it's Joan Shu, I need to double check that, is more telegraphic about delivering numbers. This is what actually happened. Now, as an economist, I find both useful, to be honest. But as somebody, if I were somebody who was not in the trade, then I would prefer the story. And this is the way I prefer to deliver anything, through stories, which is pretty much what we're doing right now. You see, have, stories remain. Okay, stories are stored in other people's heads. Numbers are not. Technicalities are not. But stories, people, that's how we learn. So that's what people can relate to. Look, I think you have children. The first thing you do is tell them stories. This is how our brain develops since we're very young. So I know my complex theory of everything, but if I cannot put it into a short and cohesive and instructive story, then I'm questioning my knowledge and the breadth of my knowledge first. And then, even if I do understand everything, I still have a problem. If I cannot deliver it, then that knowledge is lost. It needs to be digestible, just enough so that it doesn't lose any important truths.
Yeah, I mean, I
Our
100% agree.
responsibility to make it digestible, by the way.
I 100% agree with what you're saying, but I also feel like making compelling and good stories is so much harder than just delivering numbers, right? Because obviously you can invent some stories that don't really make sense, but the really good ones, the ones that stick in people's brains and really make a difference, they're not always easy to find. It's a lot of
Well,
work.
so here's my personal secret sauce is reading, and a lot of my reading is around history. So there's always a historical analogy I can use. And there is always an interesting story that around that historical analogy, because for a story to remain around for centuries, there must be something interesting with it. So I have found history as the best way to weave in my predictions.
Well, that's good. Is there a specific period in the history of humankind that has more parallels than others to what you're witnessing on financial markets as of
Well,
today?
one could argue, of course, that the more recent the history, the more relevant it is. Because we really don't have finance before the end of the 19th century, when J.P. Morgan essentially moved the locus of U.S. businesses from Philadelphia to New York. Before that, business history is not very well documented, not very well written, and very few parallels we can draw. But from that time on, from J.P. Morgan's appearance in the United States, his move from London appearance in the United States, to today, there are plenty of financial paradigms. But again, I don't think history as just a financial history. Okay, I don't just use financial history examples. I use actual history examples. You see, a problem, Nacho, is that we teach children, and I think that's a huge problem, we teach children only history of war. But there is the history of art, history of diplomacy, history of economics, and so on and so forth. Every aspect of human life has its own history threads weaved in. Okay, and they all run in parallel. So when I talk, I rarely invoke the history of war, but I will invoke the history of diplomacy or the history of economics. I will find relevant examples, and I will try to use history as a guide to the future. Very few things are entirely new. History never repeats itself, but it rhymes. So part of that prediction is trying to find the rhyme.
So you're a poet as a chief economist, listening to the music and trying to find the rhyme.
Yes, what I am definitely not, and I do want to get this out of the way immediately, is I'm not what they call a quantitative economist. So there are people out there who believe a lot in the power of models, financial models. Some of them the simpler ones can be really useful. Okay, but first of all, I'm a fund manager by trade, so I can't construct any good ones. And because I'm aware how models are constructed, ultimately you get either too simplistic models or overfitted models. neither of which can tell you anything about the future.
Mm.
So, and I'm also extremely careful of projecting the present into the future, which is what most models do. You take A that is recent, B that is more recent, and then you draw a straight line or even a curve, and you say, okay, that's the future going forward. And then you have a new government in the US, and the global order is unbalanced, and you start all over again. Okay, so you need to be sanguine about everything, and that is why I take models for their analytic capabilities, but for my projections, generally speaking, I don't put in too much trust in them. I do put a lot of trust in the philosophical way of thinking.
So talking about models and metrics, and without getting into much detail, but if you had to single out one economic indicator that you're a super big fan of and that you keep looking at to assess the state of the global economy or a specific economy, which one would it be and why?
PMIs, definitely. I do my reading every month for years now. So purchase manager indices, they come out once a month. They cover all the major economies and some smaller ones, and it's interviews with purchasing managers, either in plants or in the services sector. So you have the manufacturing and the services one. And it is because exactly it's not quantitative. Market publishes those 2-pagers for every country every month. And you get a lot of information when you read it about the state of a particular sector and an economy. So exactly because it's not very quantitative in nature, I like it because it has a ton of information about new orders, about employment, about prices paid. Just for the US, I don't use the market ones. I use the ISM, which is the original inventor of PMIs. So they do it better in the US. Everywhere else in the world, I use the market stuff. So if I had to choose one, I'd say PMIs.
That's a good one for sure. You get a lot of color with that. So going back to the calls you've made along your career, some economic calls are easy. So some others obviously have massive implications for investments and even like for your public trust, I would say. What's the most difficult or high stakes economic call you've ever had to make, and what was the outcome?
The end of 2022, I saw that bonds were not really worth much. They were yielding 1%, 0.5%. And we had an inflation wave, and we had the Fed saying they're going to hike rates, and we had the market in disbelief. So I just talked to my CIO. I said, if we cannot erase bonds from our portfolios, then we need to zero out duration as much as we can. And we need to go underweight, and we need to do this because especially defensive portfolios are going to suffer, which is crazy because if you have market tumult, you expect the aggressive portfolios to do worse, but it was in essence a bond bear market. Okay, so we needed to do something about that. Bonds were no longer the safe asset. Okay, so I'd say that was the most high stakes call I've made, at least that I can remember. I don't keep track of all of them, and I don't keep trophies, to be honest. Every day for me is new. I learn from my mistakes, and I focus a lot more on them than my wins.
2022 was definitely a terrible year. Double-digit returns across many asset classes, negative returns across many asset classes, and there was nowhere to hide, really.
No, but my call was at the end of 2022 because, again, at that point, bonds were yielding less than 1%. And you had the rate hikes, and you had inflation, and you had a generation that had forgotten how to invest in bonds.
So talking about the calls you've made, obviously, you said you made some good calls, you made some bad calls, that you're not really keeping a super close record of all of it. But what's the worst market or economic call you've ever made? And most importantly, what did you learn from it? Hey there, Quick ad break. Do you work in the finance industry and have a genuinely interesting story to share? I'm always on the hunt for great guests who bring raw, unfiltered insights to the table. Or maybe you know someone with a story worth telling? Please put us in touch. You can reach out to me directly via LinkedIn. I'd love to hear from you. And now, back to the show.
Yeah, in terms of economic calls, the one I really got bad was after Brexit, when I thought that we would see a demand shock. And we did not. And that explained to me a lot about democracy and demand shocks. So currently we have a demand shock in the US. Okay, so the people voted for Brexit, they got Brexit. And that, all the fears of the rest of us, what the hell would happen on the day after, didn't materialize because people still went to the shops and shop. Now, compare and contrast this with the demand shock that we're currently seeing in the US. You've seen the numbers that have turned sharply down, right? Consumption numbers, the Atlanta Fed indicator, they all suggest that we might even see a small recession in the beginning of 2025. So why did this happen? Why did we get a demand shock in the US? Because when Brexit was voted for, yes, there was uncertainty, but you had a government that said, okay, we'll figure this out. Okay, they tried to smooth the implications of what Brexit would become. And, Brexit did lower trend growth in the UK, but it did not happen as a shock, came more gradually. Compare and contrast with what is happening today. The present government of the United States apparently has a strategy to shock both markets and, trade partners. That has also shocked consumers, however. Okay, so that's a demand shock. So what I learned was a demand shock is not the repercussion of an election, and demand shock happens when there is uncertainty. What Varoufakis once called creative, how did he call it? Creative vagueness. There might be a better British term for that because he uses English a lot, but it translates as being creatively vague. That's a sort of thing that markets and businesses hate. Okay, so vagueness, uncertainty is something that governments and policy makers best avoid. So that's how you get demand shocks. Too much uncertainty.
That's a good one. Yeah, I mean, another thing I wanted to ask you related to all of this is, because we're talking a lot about forecasting, about the calls we get right, the calls we get wrong, what we learn from it. But I think a lot of people believe that economies have a relatively bad track record when it comes to predicting recessions and market moves. I don't know if it's because we tend to focus more on the negatives than on the positives, as we were saying before. But I mean, the example that comes to mind was when a couple of years ago, everyone thought that there was 100% chance that the US would enter into a recession. And I think Bloomberg surveyed many economists, and 100% of them forecasted a recession. That never really happened in the last couple of years. So why do economies, even the best ones, so often get their calls wrong?
I'll reason this out. No, you see, first of all, we need to get to understand how to read calls, and to be perfectly honest, it comes with the whole idea of stories and oversimplification. And that is the risk. An economist, first of all, the 100% thing, I would never say to anything. So if you asked, here is the thing. Let's say 100% of economists predicted a recession, but if you ask them, how certain each and every one of you are you that the recession will come? Maybe they were 60%, maybe they were 70% certain. So whereas you say, well, that is a 100% chance of a recession there, if you look down and calibrate those questions, because that's what appropriate forecasting is, then you might see a 70% certainty of recession. even if the headline said 100. And that's how data is oversimplified. So economists are never certain about anything. That's why Harry Truman famously said, get me a one-handed economist, because whenever he asked an economist, they would go on the one hand this and on the other hand that. So Harry Truman said, get me a one-handed economist. I think that in their need for certainty, very often, the audience of economists tends to take the prediction and never asks for a degree of certainty. Yeah. And that is what makes all the difference. So I often try to communicate a degree of certainty. I do it verbally, or sometimes I do it quantitatively. I am 70% certain, I'm 80% certain. Nacho, I have never been 100% certain of anything, including the idea that the sun will rise tomorrow. Okay, everything and anything is changeable.
It's a good point. So yeah, going a little bit beyond the headline and trying to get a little bit more granular, because you're gonna
That's where you will find much better answers than did economists get it right or did they get it wrong? Because we all got jobs. None of us got rich doing this. So when you're pushed into a corner, yeah, but what do you think? What do you really think? Will we get a recession or not? Yes, fine. I think there's a high probability of a recession that's not. Oh yeah, okay, we'll get a recession. And that's what the press wants to hear. That's what your colleagues want to hear. That's what your boss wants to hear. They want to hear your view crystallized into one thing. But if you're an investment analyst, you have to say, okay, if there is 100% probability of a recession priced in and I'm only 70% certain, well, that's actually a buying opportunity.
So you're talking about
in terms of probabilities, in terms of forecasts.
Yeah, I agree. Nothing is 100% certain. So talking about economies and the job, many economists are notoriously known for sticking with the consensus, very rarely making bold or contrarian calls, whilst others are obviously a little bit more out there and contrarian, I would say. But I see why this is happened, because being wrong alone can hurt your reputation quite a lot and can end your career. Whilst if you're being wrong with everyone else, it's just, more socially acceptable. Let's put it that way. So do you think economists avoid making, or some economists avoid making outlier forecasts because there's too little upside and too much career risk in going against the consensus?
There is definitely that, but also we're all looking at the same data. What you say, consensus, we're looking at the same data and we're reaching pretty much similar conclusions. Okay, what I'm saying now, that there is a danger to US growth, is what every other economist out there is saying after looking at the same data like I did. Okay, if you look at the same data, you will reach similar conclusions. If we get better data or more proprietary data, maybe we will reach different conclusions. I am more aware of the people who consistently go against the grain, because there are two types. There are the so-called hedgehogs. So let's put the hedgehogs aside. Let's talk about the people who make very few calls, and they only talk when they see something that's not priced in. Okay, they might do so once or twice or three times every decade. I have huge respect for that. It's a very difficult place to be. I'm not talking about anything. Consider me consensus until I see something that sticks out like a sore thumb. And then I will raise my hand and say, okay, this is where the market opportunity is, right after I've invested in it, of course. Now, huge respect for these people, and we always need them. But there are the hedgehogs. The hedgehogs, I don't know if you ever heard the term, that analysts are either foxes or hedgehogs. It comes from an old Chinese proverb that foxes know many things and hedgehogs know one big thing. So hedgehogs are the sort of analysts, the sort of forecasters, economists, what have you, who are either always out of consensus, they always speak gloom, for example, think Black Swans, Nicholas Nassim Taleb, or Dr. Gloom Rubini. Okay, if you talk to Rubini, you know that a recession is just around the corner, and like a broken clock, is going to be right twice a day. Okay, but that does not make one a forecaster. Having a certain way that you see things and sticking ideologically to that view, either that it's all going south always, or that, or being very optimistic, markets will always go up, whatever. I don't tend to subscribe to those opinions because they are extremes. And there are people who make a living out of being out of consensus. If I'm out of consensus, which I sometimes am, about smaller things, but I am, I might be more vocal about it because I know it will generate some good marketing, to be honest. And it will also raise some awareness. Guys, you're not thinking about this the right way. Okay, deregulation. I've been talking about it for 3 or 4 years. Honestly, initially I thought that Biden would not stand in the way of it, but it did. He did. But I think it was a long time coming. Okay, and that's another nature of forecasts, by the way. You might get the forecast right, you might get the timing wrong. Okay, so the point I'm making is that if I don't think that there are people who are always in consensus, because, okay, there is a rank and file that might think like that. Most of them either have a few big calls, and the real outliers, a lot of them just do it for the marketing. If you're consistently a contrarian, then you just expect the one time you get it right. But what about the 9 times you got it wrong?
Yeah. Yeah, you lose a lot of credibility, right? Like if you're always contrarian and you're 9 times out of 10 wrong, doesn't matter if you're right once. Well, I guess it's about sequencing. If the one time you're right is the first one, that's great. But if it's like the 5th or 6th or 10th one, then no one is going to listen to you.
The one time they will get it right, they will get the following. They will become gurus. That's what they bet on. But that's a marketing game that I don't partake.
I want to change topics, although obviously still talking super closely about models and markets. I want to talk about the notion of risk. I'd love to get your thoughts on that. So the finance industry has built entire models around risk using VAR, beta, volatility, many different things. But real world financial disasters often come from risks that no one really accounted for. You were talking about the black swans before, but not only. So my question for you is, do you think the financial industry truly understands risks, or do we just measure what's easy to quantify?
And of course, it's a leading question because the latter is the answer. Look, you have to think how the financial industry came to be. Before the 1930s, the financial industry was all about the broker's office. Okay, and then the Great Depression came. You would get the stock tips. Yeah, you should buy this, you should sell this, blah, blah, blah. And then it was completely discredited after the Depression. A, because nobody had any money to invest, and B, because, they drove the world into a great big recession, the outcome of which was World War II. So it was not until the early 1950s that Harry Markowitz, who got a Nobel Prize for this, made investment sensible again. And the way he did it was by quantifying risk. He said, okay, what is risk? Well, risk is something that's not, is things going really north or really south. Risk is unpredictability. And then he quantified unpredictability as volatility. Now, over the years, we questioned 2 things. One, we questioned the normal distribution, which is a statistical notion that you can actually put a number of those upside and downside risks, because we know now markets don't move in what is known as a normal distribution. They're not that predictable. Benoit Mandelbrot proved that the Dow Jones has fat tails. And the second thing that we did is we developed all sorts of ratios, like the Sortino ratio, that sort of only looks at downside risks, or VAR. value at risk. So here is my view on risks. There are two worlds, Nacho. There is the world where things generally tend to move within so-called two standard deviations. Your normal world. 95% of days fall into that world. And 95% of the times, those risks are predictable, along with our models, along with our VARs, along with everything.
Mhm.
And then there is another world where, for whatever reason, our mean reversion and our normal distribution, or at least the idea of a normal distribution, is appended. And then things get weird. And that is when you need to throw all models out of the window. Again, going back to the job of the CEO, the CFO, the CIO, the chief economist, whoever you want to call them, if they hear that the music has stopped playing, or where you had classical music, now you have heavy metal, then you need to know that your assumptions of risks are at this point wrong. And the first thing you need to do is turn to your risk manager and have a very honest discussion. And the risk manager will tell you, okay, things have changed, yes. So my models, I cannot throw them in the toilet completely. But for good measure, add risk. So where I thought my VAR was £1,000, let's make it £2,000. Okay, and that will get you much closer to reality. And then that is the job of the C-level. That is the job of all these chiefs. If they do not do this, then we're not doing our jobs. And that is how you deal with risk. There is risk on a normal day, and there is extraordinary risk. The chiefs are supposed to know which day of the week it is.
And remaining nimble and adjusting as fast as possible when you get to that point. Then
yes, it's being actionable. It's not allowing inertia to take hold. Oh yeah, it will all be fine. It's one of those things. Okay, case in point. One of the things I famously got wrong. In February 2020, I was being asked about COVID and whether it would be a thing. And I said, look, we got over SARS historically in the last 150 years. We got over, with the exception of the Spanish flu, for which we didn't have antibiotics, by the way. We got over each and every one of these pandemics without major upheaval in the world. A month later, we were in lockdown, the first in human history. That was a black swan, by the way.
Yeah.
A global lockdown. Okay. Did I get completely wrong? No, I spoke of the world I knew. Okay. Could I have known in retrospect that European countries would follow China's example to complete lockdowns? I'm even then not able to see how. But on the first hour of the lockdown, when I walked around a little bit and I saw an empty neighborhood and all the stores closed, and it was very visible to me, then I said, oh shit, and I knew our world had changed. So clients called me because they saw exactly the same thing as I did. It was very visible, that one, to everyone. It was not a financial crisis. It was the other sort. And they asked me, should I be afraid? I said, look, your stocks are going to take a hit, your bonds are going to take a hit, but let's wait for the Fed to see what they do. And that's the other way to think about risks. Risks can materialize. Remember the 2023 banking crisis in the US, which, by the way, came after deregulatory efforts from the Trump government a few years before that. We knew that the Fed would intervene. So risk is only part of the question. Will somebody save us on a systemic basis from a systemic risk? Is the other. It's not just what you do. You need to think, is there a safety net for this? And by the way, when it comes to the world of finance, central banks are always at the other side of the risk equation. Are they doing anything about all of that? Because if they are, maybe I should not be afraid. Maybe I should just take the hit and invest more.
That's what a lot of people famously call in the case of the US, the Fed put, no?
Yes. So That is, when you talk about financial risk, is the central bank, the Fed, the ECB, whatever, put active? That is the next question. When you hear that the tune has changed or that the music has stopped altogether, will the central bank do something about it? And if the answer is no, run for the hills. If the answer is yes, just wait for it. And maybe buy some on the downside. That is being greedy when others are fearful, and fearful when others are greedy. Warren Buffett, not George.
What's the type of risk that keeps you up at night that you think people are not paying enough attention to? And I'm not just talking about a market crash or inflation. I'm talking about maybe bigger things like cyber threats, social unrest, and things like that.
The only thing, I'm 46, Nacho. The only thing that keeps me at night is when my daughter comes to our bed and kicks my face. Which happens more often than you would think, by the way. So yeah, she's doing martial arts now, so she has a stronger kick. I don't lose sleep over anything. You see, I did go through a financial crisis. I stocked pasta. I ended up eating still pasta for the next 2 years that my wife was purposely feeding, just as a lesson there. Nothing keeps me up at night. Life will happen. Losing sleep over it, losing life over what might happen, is not any way to go about things. That's what I've learned. I only lose sleep when somebody pushes me out of the window, of the bed, or when Panathinaikos is playing late and then I can't sleep and that sort of thing. I do not lose sleep over the economy, finance, Trump, Biden, Mitsotakis, whoever. I do, in the past 10, 15 years, I lose sleep to none of them. Why? Because I'm a veteran of Lehman Brothers, the Greek crisis, the Cypriot crisis, Brexit, the pandemic. I'm a veteran of many crises. So no, I lose sleep over nothing. Everything is something we deal with, and that's what we professionals need to do and what we need to communicate to our clients. Okay, you don't need to lose any sleep over it, and that we don't lose any sleep over it because we're professionals. We know how to deal with these things.
That's a good answer. We're soon running out of time, so I want to squeeze in one or two last questions. We talked a lot about the past and the present, but maybe focusing on the future. Finance is changing fast, and some shifts obviously are bigger than others. If you had to predict one major transformation in global finance over the next decade, what would it be? And I left this question intentionally very open, but I'm curious to hear what you say.
There are two things that I see. The one is digital currencies, which I think will probably append the unrecorded economies, which means that a lot more tax receipts and probably fairer taxation across the board, especially for countries that don't have particularly fair tax systems. And the other one is energy. So although this is more of a science project, you see, in all the tariff wars and all of that, a news that was missed a couple of days ago was that in France, a reactor called West has managed to increase fusion plasma for 30% more than its previous test. Why is that so important? That will change everybody's future. So those reactors, West or ITER, tokamak reactors, are trying to create energy from fusion. It's not fission, which is nuclear. You take a plutonium, which has a lot of atoms, and then you start smashing it. And you get, so many million reactions, and you generate power out of it. Fusion is the exact opposite. You take two hydrogens and you fuse them into a helium. Okay, and that generates a lot of energy. And if you manage to control this, that's how hydrogen bombs work, by the way. And if you manage to control it, which is what hydrogen bombs don't do, if you manage to control the reaction, then you can get a lot of energy just using water as a raw material. Hydrogen, the thing that's easier to find in this planet more than anything else. I think the world, which is desperate for a new energy paradigm, and no, it's not going to be policies that save us. It's going to be technology once more in human existence. I think the world should pay attention to that stuff way more than it pays attention to all the trade stuff. Cheap energy change finance and the world entirely in the next 15 or 20 years.
Interesting. And one last question that I thought you were going to go in that direction, but you didn't. AI, obviously big buzzword at the moment. How do you think AI is going to change the way we forecast the economy in the future, your job as a chief economist, and more broadly, finance in general?
Okay, good one. I got asked the same question yesterday. I will answer with the same thing. Why do you ask me? Why don't you ask an AI? And I'm not being facetious here. The reason you ask me is because you're interested in my opinion, not ChatGPT's opinion on the subject. Right? And why are you interested in my opinion? Because the viewers of your podcast are human. Anyone can ask that question to an AI and they can give you an answer. The reason you're asking George Lagarias, chief economist at Forbes Mazars, is because you trust another human being. Remember the robo-advisors that were all the rage and now they're not anymore? People don't trust their money to models. They don't trust... if you go to a hospital, you wouldn't trust a computer. You want to see a doctor. Okay, so you trust for the important stuff. Humans trust other humans. Humans look for answers to other humans. We can use AI as a tool, but those of us long in finance know that even the best AI at the end of the day is a model with biases. So there is never a money-making machine. And if it is, it's going to be kept hell of a secret. And as long as humans are running global finance, AI has a part to play, but it's auxiliary. Because you would never entirely trust your money to a computer. Would you naturally trust your money to a bank solely run by AI, not humans?
So my answer is not today, but the thing is that I cannot even imagine how AI is going to look like 5, 10, 20 years down the road. So I'm a bit biased. If I could see how it's going to look like in 20, 30 years, I suspect the answer would be yes. But if you ask me, would you do it today? The answer is no.
Well, so I'm saying that based on the data we have today, AI will be auxiliary. If consumers and people who have budgets are AIs, then AIs will trust other AIs and will write ourselves out of the global economy altogether. But as long as the decision makers, your consumers, the people who listen to your podcast are humans, then trust will go to humans. Maybe fewer humans to run organizations, to be sure, and more efficiently. But the decision making will be human, not mechanical.
That's a great way to put an end to this podcast, George. This conversation has been nothing short but amazing. You spilled some value bombs in there, like so much gold dust. Thank you so much for all of those views. For all of you that are not following George on socials, please make sure to follow him on LinkedIn, where he publishes very high quality content on a regular basis. George, thank you so much for coming to the show. It's been an incredible pleasure, and best of luck listening to the music and trying to identify when the tune of it changes this year.
Thank you very much for having me, Nacho.
The Blunt Dollar is written, produced, hosted, and edited by me, Ignacio Ramirez. Everything you hear, concept, script, sound design, and production comes straight from my desk, and occasionally my kitchen table. Thank you so much for listening, and join me in the next episode of The Blunt Dollar for more raw, honest finance conversations.